Hey guys, what's up? Spenny here. So I have a super exciting company to present to you guys today. This stock, in my opinion, could easily 3x by the year 2025. Now, a lot of YouTubers, and including myself, do project out these high risk, kind of high reward companies out there that are really extreme growth stocks that could 5x the next 5 years. And it's true when we say that these companies could, but there's a lot of risk with a lot of those speculative plays, right? The stock I'm presenting to you guys today is very low risk. We have tons of financial data on this company. They have a great track record of bringing great returns to investors. And so this one is very low risk and high reward because we're going to take advantage of a great rebound play here. Very established company. It's just getting beaten down and is now presenting a great buying opportunity. So if you're interested in possibly 3xing your money over the next 4 to 5 years in a safe stock, this video is definitely going to be for you. Make sure to watch till the end. Okay guys, before we get into this video, make sure to check out that Webull link down below in the description. If you sign up and deposit just $100, you'll get free stocks. And also make sure to subscribe to this channel if you want to see more content, and drop a big thumbs up on this video if you like it. So yeah, let's get straight into this video, guys. Like I mentioned a second ago, this stock could 3x over the next 5 years, and it's a safe stock. I think this is a great opportunity for us, but I'm also going to be giving a strike price when I think somebody should enter into this stock. So for now, we're going to have to add it onto our radar, watch how the stock trades over the next couple months here, and then there is a catalyst coming up that I think could present a great buying opportunity. And if I'm right about what I think is going to happen, it's going to present an amazing buying opportunity. So the stock I'm talking about is couche-tard. Ticker symbol is atd.b. Now this company is actually being recommended by the Motley Fool. I'm part of their stock advisory program. So it's not just me kind of recommending it, guys. It's actually the Motley Fool who's saying this is a great buying opportunity. And I do agree with him that right now is a good buying opportunity. But to really limit that risk, I think there's a better opportunity that could be coming very shortly, where you can get in at a better price. So if you don't know what couche-tard is, it owns and operates one of the largest collections of convenience stores, and they're global. They're around the world. So it says here, why buy? It has a dominant business with highly attractive economics. There's plenty of run room for growth with loads of financial capacity for acquisitions. It has a historically attractive valuation, and that is true. Its valuation now is really compelling, and that's what got me interested. And there's been a massive dip in its share price just recently that we'll get into that actually put it on my radar. And if we look at the history of the stock and how it's rewarded investors, so if 10 years ago you invested $10,000 into this company, they've grown at about a 20% compounded annual growth rate, and that $10,000 would have grown into about $94,000. So great track record with this company. And getting into its valuation, so we look at its historic PE ratio. Over the last 5 years, it's averaged at an 18 PE ratio. Right now, we're at about a 10 to 11 PE ratio. So historical lows we're at right now. You can see back in 2008, we dipped under 9. It was about an 8 PE ratio, so super low. We're not at those levels. However, I wouldn't be surprised if we dip a little bit under 10 in the short term, and that's when I'd be jumping pretty heavy in this stock. But regardless, historically speaking, right now is a very cheap valuation for this company. So yeah, guys, that's really what's getting investors excited. And if we look at what the Motley Fool proposes here, they're basically showing us that its stock price over the next 5 years could go from around $42 a share all the way to $106 a share if they meet projections that they're proposing here. That would represent about a 2.5x return, which is great, but I actually think that we can have an opportunity to 3x over the next 5 years if we get in at a better price. My strike price isn't $40. My strike price would be $35 in the stock. That's where I'd enter position into it. And then if it ever went down to $30, that's where I see extremely low risk, almost no downside, and that's where I'd put all my money into the stock. Any extra cash I have, I'd be throwing at this stock hand over fist into this company. So if you ever see it at $30, I will be posting another video on this stock and I'll be updating you guys what I'm doing. But I can tell you right now, I'd be loading the boat on this one at $30 a share. I don't know if we're ever going to see $30 a share, but there could potentially be a catalyst coming up that could drop the stock. And that's really what I'm looking at. And that's when I'm looking to enter position into this company. Right now, I'm just watching it and waiting to see if it'll go lower, because right now at around $38 a share, I would say your short-term risk is definitely present. Long-term, I'm sure you're gonna make money. You know, I have almost no doubt on that, but I just think there's a better opportunity coming here, guys. You know, I think it's gonna get close to that $30 mark. The reason why it has dropped a lot recently, it went from about $43 a share down to 36, is because of a deal that it recently announced. So it says here, couche-tard seeks to save Carrefour bid as Canada pushes France. So there's been this massive divide and if this is a good deal. So couche-tard announced a $20 billion deal to take over Carrefour. Now this is a massive deal, a huge acquisition. Investors didn't like that couche-tard wanted to do this. And so the stock tanked on that announcement of the potential acquisition. And one of the reasons why it tanked so much, and it would have continued the downtrend, which I was actually hoping for, but that downtrend stopped because now France is saying no way they're gonna do the deal. And so now the stock is rebounding because investors are no longer worried about the deal actually coming true. So who knows? The stock might not downtrend anymore. It might go back up to its $43 a share where it was before that dip. But the real big reason why it dipped so much, and I truly do believe it would have continued to dip if it wasn't for that recent announcement, is because of the premium couche-tard was willing to pay for this company. So Carrefour was trading at about 16 euros in Paris, where couche-tard offered 20 euros per share. So that's about a 30-some plus premium on its share price. People didn't like that premium that couche-tard was willing to pay for it, and I'm actually not even a huge fan of that myself. The Motley Fool wasn't concerned though. They talked about it in their article. They loved the deal and they loved that the stock dipped massively from it. They thought it was a great buying opportunity. I agree with them, but at the same time, I don't think couche-tard should be paying that kind of premium, especially because Carrefour is actually losing market share to some bigger players. So it's not like they're really thriving too much. So right now there's a lot of risk in the short term with this stock. This deal doesn't seem to be sorted out yet. So I think we're gonna see a lot of volatility in the short term, but that's not the catalyst I'm talking about. The catalyst is actually its next earnings report. I think it's gonna be terrible earnings that's possibly gonna drop the stock a lot and present a great buying opportunity. Now the reason why I'm predicting a terrible earnings report is because of what's going on with the lockdown situation, especially in Canada. So Quebec is fully locked down right now. They're locked down for 4 weeks. They have curfews. They can only leave like a kilometer from their residence. So nobody is moving in that province in Canada. And a similar thing is happening in Ontario. Ontario has heavy restrictions. A lot less traffic is going to be going into their stores. And then of course, Ireland has also been heavily hit by CV just recently as well. So I'm expecting this quarter to be something similar to what happened in March, where there was just a lot less sales and a lot less people going to their convenience stores. I think this is going to present a good buying opportunity. If we look at what kind of impact it could have on the stock though, so we need to understand how many convenience stores couche-tard actually owns. In North America, they have about 9,200 convenience stores. So they have a lot of convenience stores. This is a big company, but they're primarily on the East Coast. In Canada, you don't see many on the West Coast where I'm at. I live in BC. In BC, we have about 300. But in Ontario, where there's some pretty heavy restrictions right now, there's 682, and then there's also 120 affiliate stores. And then in Quebec, where the big restrictions are, there's 453 plus 205 affiliate stores. And then in Quebec East and Atlantic, there's 351 corporate stores. So basically what I'm predicting is that the stock is gonna have a really bad earnings report because the East Coast stores are going to see very little traffic, and that's primarily where they're based out of. And plus, couche-tard is all over Europe, and there's lots of parts of Europe that have been heavy into lockdowns this past month or 2 months now. So I think this earnings report is going to be terrible, and I think the stock is going to sell off big time. I'm hoping it goes below $35 a share, and that's where I'm going to be buying into this one. I see this just as a very temporary risk where it's possible 1 to 2 quarters we're going to see a downtrend in the stock. So don't be shocked if you see 4 months of downtrending in the stock. Don't let that scare you away from it. It's going to represent an amazing buying opportunity if things go the way that I'm projecting them to. And I really hope that it does downtrend, because right now we're seeing a bit of a rebound between this whole France deal with their acquisition. I think that's going to reverse, especially on the next earnings report, guys. And if we see the kind of the effect that CV had on them back in March of 2020, we can see that the first quarter, so January 31st, they brought in about 16 billion in sales. CV hit, they dropped massive, down to about 9 billion. And then towards the end of 2020, they only slightly rebounded, so really not much. I'm curious to see how this next earnings report is going to be. I think it's going to be something like we saw in March of 2020, and I think the stock is not going to be happy, especially because people don't like the direction of where the company is going right now. Personally, I'm pretty neutral on their direction. I think I'm pretty generally okay with the deal and the acquisition they're seeking. So yeah, guys. Anyways, I think this is going to be a great buying opportunity. If you can get in the stock under $35, I think it's a relatively safe 2 to 3x return over the next 5 years. So yeah, let me know down below in the comments what you think of this play. Make sure to drop this video a big thumbs up if you liked it, and I'll see you guys on the next video.